Good morning. Let's go through today's acquisition. So let's get started with this one. Blackstone started with capital to buy extended stay for $6 billion. For those of you who don't know, Blackstone is one of the largest private equity firms in the world, if not the largest. One of their founders is Steven Schwartzman. If you don't know him, let me show you Steven Schwartzman. So that's the guy. I highly suggest you to check him. There's two great books about him. One of them is his kind of like his own version where he wrote it down. The other one is actually a book written on him and other private equity. I think it's Titans of something about Titans of Capital or something like that. But let me actually check with you. I have it on my Audible. Might actually help you. Yeah, so the other book that's talking about Steven Schwartzman is actually King of Capital. Really interesting book about kind of like how they built Blackstone to be one of the largest private equity in the world. So Blackstone, let's go through this. Then Blackstone started capital to buy extended stay for $6 billion. Agreed to buy hotel operator Extended Stay America for $6 billion. The complete company said. How crazy of a number that is. But it's funny, it's interesting. We probably were involved in more than 100 acquisitions in the last year alone, mostly in the 1 to 20, 30 million a year in revenues. The process is pretty much the same. The only difference is that those guys just have access to tons of capital to play with. And in general, right now, there's trillions of dollars in the market looking to be deployed. So if you think there's literally never been a better time to do acquisitions like right now. The government is literally giving away money. So let's see what's happening here. Is the booking plunged across the US over the last year, specialized in temporary housing for healthcare purposes. Healthcare is going to be a very interesting sector in the next decade. Private equity company, Blackstone and investment firm started with cash offers. 19.5 per share represent a premium. So they pay. That's the thing, when you buy public companies, you usually need to make an offer that is some kind of a premium to be able to do those. Share of extended stay rose more than 70% before the opening bell. That's pretty cool. And then we are excited about the company growth. Extended stay stock has more than doubled in the last 12 months. Wow, its larger peers Marriott and Hilton, which gained between. It's crazy to see that those numbers of those hotels are going up actually right now with the virus, right, with the pandemic. Let's see another news. Blank check firm Greenrose buy 4 companies to build US cannabis network. That's pretty cool, right? Another cool sector to think about that I know a lot of people are looking at the moment. And a lot of those blank check companies right now, right? You see another SPAC. Blank check company, if you don't know, is basically a SPAC. It's a special purpose acquisition company. It's a company that sole purpose is to go public in order to buy other companies, or at least one company. So here it says to buy 4 companies to build cannabis cultivation, distribution, and retail network across the US. Wow, betting on the nation's pot industry opening up soon. Very interesting sector to be part of. Deal making in the US cannabis industry has surged in recent months. Expectation that President Joe Biden administration will relax federal prohibition and make it easier for companies to operate similarly to rivals in the alcohol or tobacco industry. How cool would that be, right? If cannabis is going to be basically as legal as alcohol and tobacco. And I don't know what's your opinion, but in my mind, it's like, if alcohol is legal and tobacco and cigarettes are legal, then cannabis, no reason why it shouldn't be legal. Greenrose will buy Shango Holdings. 3 deal value at 210 million and maximum earnout of 110 million. So that's another pretty cool deal structure for you to see, right? Even with those large companies. So they buy the companies for $200 million, 210, and 110 of that is on an earnout. I'm not sure if it's part of the 200 or in addition to that, because it doesn't say here, but it's just to show you that even with large companies, a lot of the purchase price is being dependent on specific milestones that the company need to achieve over time, and that's what an earnout basically. And an earnout can be done based on everything that the companies are negotiating. You can literally get an earnout going based on revenues that the company go through, based on profits, based on employees that you hire, literally based on any project that you have on the table. You can attach an earnout to that. The combined company will have 9 dispensaries and over 300,000 square feet. Nice. Greenrose said it expects temporary move from Nasdaq to over-the-counter trading because companies growing who are selling marijuana in the US cannot list on major stock exchanges. That's really interesting, actually. The fact that you cannot list on major stock exchanges right now, selling marijuana or like, cannabis in general. So they're moving to over-the-counter trading. Interesting. So basically less liquidity, but it's good because it will allow them to basically build a company still as a public company and use their stock as a currency to do more deals. The company also plans to hit Canada's NEOS exchange after the deal closes, though there is still a chance it may not have to leave the Nasdaq, Green Rose Chief Executive Officer Nikki Harley told. We felt that when we did our IPO back in February last year, that there would be a chance and we would get regulatory relief before we close our business combination. I think there is still a chance that does still happen. It's going to be a close call. Green Rose also looked at the deals with cannabis software companies. Interesting. Right, it's also interesting to show you that there's software in cannabis as well, right? Everyone is using software. I don't care what sector you're at. Over time, you're going to have to become some kind of a technology company. Even if for now it's just having some kind of a CRM and tools to track stuff. But as we grow, as we develop, every company, I don't care what company, is going to be some kind of a technology company as well. Bentley Systems to buy software maker Sequent in $1 billion deal. Wow, Bentley. I'm sure everyone here knows Bentley, or if you don't, just those guys are Bentley, right? I'm sure you saw some of those cars out there. That's Bentley. Infrastructure engineering software maker Bentley Systems Inc. said on Thursday that it's agreed to buy privately held geological and geophysical modeling software developer Sequent for about $1 billion. It's pretty interesting, right? To see Bentley buying software companies. Bentley, which makes software for the design and construction of roads, bridges, buildings, and campuses, will buy Sequent from investors led by private equity firm. Interesting. Excel KKR for $900 million in cash and the rest in stock. Again, cash plus stock, right? And KKR is also one of the largest private equity firms in the world. Sequent software is used for large products, including road and rail tunnel constructions. The deal is expected to close in the second quarter and will add about 10% to the Bentley annualized recurring revenue and earning before interest, taxes, depreciation, and amortization. Wow. That's big, guys, right? So when a public company, so let's say a public company is being traded for 20 times multiples of EBITDA, and they're buying a company, private company, for let's say 10 times, they immediately have an upside on their stock because they're buying companies at 10, but they're trading at 20. That's why they can offer such great prices for some of those companies, because they know that no matter what, they will have profits right away from the increase in their stock value, right? From increasing revenues and by their increasing the stock value. So really, really interesting deal. Renault to sell its stake in Daimler to reduce debt. Interesting. So that's another type of a deal to show you that some companies out there have a lot of subsidiaries and small companies, and what they do is they sell companies, what they call a carve out. They sell companies that they don't necessarily need, or maybe it's not their main focus anymore as a business. So they just sell it to, in this case, reduce debts, right? So let's see what's happening here. French car maker Renault said on Thursday it will sell all of its 1.57 stake in Germany, Daimler, in order to speed up the leveraging its automotive business. Renault said in a statement that it would sell its 16.5 million Daimler shares through replacement to qualified investors via an accelerated book building process. Interesting. The industrial partnership between Renault and Daimler remains unchanged and is not impacted by the financial transaction. Cool. Just to show you again another type of a deal structure, even with large companies. Like sometimes also to show you that even if a large company is doing an acquisition, a lot of them don't work the way that they wanted. So eventually some of them just sell them back, hopefully for some kind of a profit, or it just may be a strategic decision to stay focused as a company. Let's check another news. SoftBank-backed Grab in talks to go public in nearly $40 billion SPAC deal. Wow. So SoftBank is the largest venture capital firm in the world. They raised the largest fund out there. They invested in some of the most famous companies that you know about, like Uber, like even, a lot of you probably heard about what happened there with WeWork. But let's see how they're up to. So Grab Holding in talks to go public through a merger with a special purpose acquisition company. Again, that could go It could value the ride-hailing giants at nearly 40 billion, making it the largest ever blank check deal. Wow. People familiar with the matter said on Thursday. Wall Street developed. Grab is expected to raise between 3 billion to 4 billion from private investors, according to the report. And the reason they can raise from private investors, obviously, it means by going to the market, they raise from the retail market to have some capital to continue to grow the business. Reuters first reported in January. Silicon Valley-based venture capital firm Altimeter is back to SPACs. A lot of those SPACs are going on right now, And again, SPACs are shell companies that raise funds through an initial public offering to take a private company public. Other recent SPAC holdings with merger with a blank check firm backed by a billionaire, Alec Gores. Who is this guy? I'm just curious. Let's see. Alex Gores is an American billionaire businessman who made his fortune through leveraged buyouts technology firms. Cool. You see, so another guy, multi-billionaire from buying companies, right? Really, really interesting. Let's see. Let's check another deal or two, and then we can end. So Prada's CEO sees 2021 sales growing to $2 or $3 billion. Wow. So Prada, if you have a girlfriend or wife, you're probably familiar with those guys, right? All of their weird bags or whatnot. I think they sell everything now. I'm not the person to ask, but okay, let's see what they're saying. So Italian fashion group Prada expects revenue to grow this year by after pandemic-driven fall to 2.4 billion. Interesting. Okay, so the numbers, it looks like going up. Said the company pledged to remain independent and remain focused on internal growth while not excluding brand acquisitions. And again, all those companies, big companies, they're buying companies. 2019 revenues totaled $3 billion. So Italy, largest luxury group, could be approaching pre-pandemic levels as early as current year if it hits the top of its range. That's actually pretty insane to see companies, retail companies, that are going back to their previous numbers, because it looks like right now is slowly, it looks like we're opening up the economy. I mean, people just go insane. People have FOMO like never before, and they just, try to go back to life and I guess buy all the Prada bags that they can. Consulting firm Bain forecast, and Bain is one of the largest consulting firm out there, forecasting November that the luxury sector would take until 2022, early 2023 to recover to 2019 levels after the shock of the pandemic. Yeah, that's what I was expecting. Obviously, this year performance will depend a lot of the development. Cool. Barely said in the Zoom call. That's awesome to hear, right? Like you see like 70-year-old CEOs, everyone using Zoom now. It's pretty cool. It's also really helpful right now for doing deals, for doing acquisitions. What else we got here? We are focused right now on our own development. Great room for growth. Don't want to, but we are open if we really find an opportunity, not a small, medium-sized brand, but a large one. So they're still looking for acquisitions, as you can see, to buy brands. Yeah, so pretty cool. Some interesting news. Hopefully you learned a little bit about what they're up to, a little bit about Blackstone and Renault and the fact that they have carve-outs and grow acquisitions and use earn-outs in their deals. It's really interesting to see some of those largest deals to then take those lessons into small business and implement them in small business until we'll be able to do those large deals as well. So I hope you got some value. If you like it, subscribe, let me know in the comments below what you think. And yeah, I'll see you soon.